Hello and welcome to FinTech Diary. The world of FinTech is evolving constantly, and we at FinTech Diary try to map this trend for you. My name is Amol Dethe, and my guest for this chapter is Varun Mittal. Varun is a seasoned professional. He has been working in the FinTech and the whole financial services space since almost 2 decades. He has been operating from Singapore and covers the whole Asia and the global emerging markets. Varun, glad to have you on this show.
Pleasure, Amol. Looking forward.
So, first of all, when the whole world is talking about the funding winter, when the fintechs are talking about the profitability and the sustainability, and the major challenge is this whether investors will pump in more money or whether the fintechs will become profitable. How do you see the whole Asian markets when it comes to the fintechs? What are the major things that are you seeing right now? Are they consolidating? Are they struggling to raise funds? Or are they focusing on profitability and sustainability?
So I would say broadly, there some things which are country or region specific, and there are some things which are overall broader themes. In the markets where the public markets are mature, so in those markets, the companies are looking at what are the metrics you need to go public from that perspective. So India, for example, you would see a lot of fintechs already gone public and the others going public. But if you look at, let's say, Southeast Asia, you would not see a lot of them go public from that perspective because the depth of public markets is not that big for most of these. Some of them may do it in Indonesia or Thailand for that matter, but from a percentage or proportion perspective, you would not see scale of that sorts in Southeast Asia for that matter. So that public markets thing actually has a second order effect that if you cannot hit public markets, then the second order becomes consolidation. You do not see a lot of consolidation in India because if you are at a certain stage, you can go SME exchange or the main exchange and you can list. In Southeast Asia, because you cannot do that, then you would look at consolidation because you would need to be at least at a certain size to be able to do it. So the premise is from their perspective, the fact that I would have to meet the due diligence team, I'll have to go to my board, I'll have to make the case, my post-merger integration team, the delta effort does not change in small amounts. So then it will gravitate towards either very small deals where you don't need to go through the whole process where you can just consume it, or it would need to be very big. So if you're somewhere in the middle, it becomes complex. So if you see regionally, the M&A is happening either at very early stage. You are having like sub $50 million companies which were acquired for IP and team, maybe some stock, but the cash is always below sub 50 million. Or you're looking at like super mega bulk deals. So if you look at in an Indian example would be Fullerton selling a part of their asset, or the larger assets happen. So middle doesn't work from that perspective. And even in Southeast Asia, the same thing happens. India, you would see both India and Southeast Asia, you would see from an acquisition perspective, it would primarily be East Asia acquisition. You would not see a lot of American and European companies coming and acquiring fully assets. They may invest in a round, but not acquire the asset. So Southeast Asia, you also would have some Chinese investors. India would not have the Chinese investor element. So Southeast Asia would look at Japan, Korea, China. India would look at Japan, Korea. From that perspective, from an acquisition perspective, I do not see too many Indians buying Southeast Asian or Southeast Asian buying Indian assets. If at all they do, they are all sub $20 million transactions, which are to get a foothold that they're subscale transactions for that matter to meaningfully impact the parents' balance sheet.
Okay. Noted your point, and I think I copy you. Public market is a very interesting thought that you shared. We have seen a couple of fintechs in India now in the capital market. And performance has been, in the public market right now in terms of how the shares are valued and everything. Uh, Coming back to specifically on the funding winter, which is going on since more than a year now, and we do not know how long will it continue. So, what is your sense? How investors stop signing checks completely, or they are going very, very cautious, not only for India but overall, Southeast Asian market for them?
So the simplest example I would say is if a company is looking to raise money at X metrics from it, all VCs have to look at do I have similar companies in my existing portfolio who are looking for bridge round
Uh-huh.
with a better payoff? So here I know the company, I already have some skin in the game. So my portfolio company, for example, is a 300K revenue run rate and seeking X million valuation. Now, if another company which is not that far on the cycle and a 200K revenue run rate, things are similar direction, then why should I pay more for that? I'd
Uh,
rather spend. So my first priority becomes taking care of the existing ones. There would be new checks, but then the bar is very high. So you need to show a better position, better ROI or something compared to the existing portfolio of the investor. So your biggest competition is not another startup. Your biggest competition is the existing portfolio companies who are also seeking capital at bridge round at flat valuation from that perspective, where the investor has the ability to say that for them to explain to their IC is also easy.
uh,
That we invested $3 million at 15 million valuation when the revenue was 1 million. Now the revenue is 2.5 million. We are able to invest more and get a bigger ownership stake, and rest of the thesis remains same.
right,
So from that perspective, you would actually see some VCs saying they would prefer the downturn to last longer
right, right.
because that allows them to enhance the ownership in some of those assets.
Uh,
For the founders, the premise is there are new verticals opening up, but the bar is very high.
uh,
The,
uh,
the FOMO is gone.
uh,
And if I look at simple metrics, right? So interest rates are not cut. There is a
right,
assumption it may be cut, but the
right.
risk-free return is 5%
Yes,
for US Treasuries. It was 0% 3 years back. So your IRR threshold is a lot more higher.
yes.
So as a founder, and you're looking for something which is a journey which is 8 to 10 years, and
Uh,
you're looking at a 5% higher IRR for the whole journey,
uh, uh,
because I have to put the capital today from
yes,
that perspective. So which
exactly.
is why the bar is very high. So the checks are happening. You would
Uh,
have deals, but you would see either so the first priority becomes either these are bridge deals on your own portfolio.
uh,
Second would be like complementary.
uh,
And then you would probably see some larger rounds also because the people who are sitting on the large funds and they still
right,
have to do it. But then they would again consolidate behind fewer bigger bets.
right.
And okay, these are the category leaders. We go behind the category leaders from that perspective.
Uh,
So again, what happens in this kind of thing is the middle gets crushed.
uh,
The middle gets crushed.
right.
So that's what's happening. So it's
Uh,
not that there are no checks. It's just that the bar is higher
uh,
and the
uh,
flavor is behind going after stuff which is more proven.
uh,
Because if you see the VCs which were raising, some of them have not finished the fundraising for their own fund, or if they have finished, they need to wait a bit more longer before they go back.
right.
So they have to stretch the same dollar for a longer duration
Uh, uh,
because now they know that the next fund is farther apart because a lot of them have to collect a lot of AUM. I mean, they grow by that, right? You do not see too many VC funds who continue to do a 20 million or a 50 million fund again and again and again. They want to go to 100, 200, 500 from that perspective. So they know they have to stretch a bit longer
uh,
uh, to get the LP access.
Meaningful one. I quite agree with you. That meaningful thoughts there. But tell me something more about the VCs or specifically investors. Uh, do you think that it's also tough for now specifically VCs and investors to raise funds for themselves and create large funds, which was quite easy earlier because you were ultimately they also raise from family offices and
Mhm.
different investors. That is one part. And why I'm asking you this is because we have seen quite a transformation in the in the VCs and specifically the funders as well. For example, Sequoia became, peak or, Media just recently left the Indian market. So what's going wrong if I ask you straightforward with the VCs or the investors community?
See, what I would say is this, right? I won't say anything is going. So Sequoia did not leave technically. The Indian entity spun off it as a separate vehicle. So they still have the same team and everything. It was a spin off. GGV also did that. So globally, what happened was a lot of the funds which were both America and China, they spun off America versus non-America. America and Europe becomes one, and Asia and China becomes separate. So that was a lot more. There's a lot more to it from a geopolitical world than actually just being India doing anything per se. Funds keep coming, funds keep going, and it's different priorities, different objectives from that perspective. I have not seen like a massive exodus per se of funds leaving per se. Funds restructuring themselves on geographical lines is pretty normal. From that, like if you see, right, corporates always have this, right? They will create a department, and then the department goes away, and then department comes back. So between product and channels, you always have that reorganization always happening between products and channels in any financial institution. So I would not worry that much about that per se. What would be important is to look at how vibrant is that ecosystem from that perspective, that how does the outcomes look like, how does the sustainable outcomes look like from that perspective, for the larger global investors. That is, I would say, more critical than one or two funds, because you see, honestly, is always adding funds is also not good, right? So the talent also needs to circulate, right? One fund stops, the people circulate, the talent circulates, new fund forms. So that's a normal cycle of evolution.
Right. Let me shift your focus to India specifically now. Obviously, the number of fintechs are growing. We have more than 20 unicorn fintechs, more than 100 startup unicorns, and now the race has been also shifting from payment to lending. There are a lot of new segments, insurtech, wealth tech, cross-border payments are emerging, and so the prima facie or on the face value, the fintech ecosystem of India looks really nice. But many of them are now, worried because the funders, or specifically, they receive the funds from abroad, or the foreign investors are the largest stakeholders here. And because of the funding winter, they are not, receiving the same amount of funds which they used to, receive earlier. How do you see, the Indian market specifically on the funding side? Do you see it's going to be really tough for Indian fintech to raise funds maybe over the next 2 to 3 years? What's going wrong on that side? Or are the investors specifically from, or investors are more demanding now? How do you see the situation and what is happening there?
Yeah, I would say broadly what happened was there was a like mad frenzy at the peak, where like you would have up rounds every 3 months or 6 months, and companies raising at 50x revenue multiples from that perspective. So premise is the good companies can still raise money. The good companies can still raise money. I mean, you recently had some companies announce decent size fundings, even as of last week. So it's not that the funding is not happening. And if you look at AI, for like new AI company raised another 40-50 million seed round in this climate, Krutim or something like that, in India. So it's not that the capital is not there. Of course, the premise is everybody's hope was that, because you see what happened in COVID was there was a massive consumption boom. So now you have to look at, okay, how sustainable is that consumption? A lot of these buy now pay later companies went through there, and RBI also came and says a lot of this consumption is debt fueled. So the whole cycle. So there is a wallet company or a lending company which is making money there. Then there is a company which is issuing that card. Then there is a company which is doing that processing. There's a whole value chain behind it, right? And it was all bet on that the sub 1 lakh, sub 5 lakh loans, 50,000 loans from that perspective. And at that time, income was increasing. People were getting 10, 20, 30% increments and everything. So it was all fine. But now the incomes are not growing that fast. The consumption is tapering down. So there's less consumption, less repayment, less loans, so everybody who had a hockey stick growth revenue curve from that perspective, you have to replenish it with something else. So what has happened is, because a lot of that story that video conferencing will take over. We would use Zoom, but now you actually use less compared to 2 years ago. You use less Zoom today than you were using 2 years ago, right? So it is not that your Zoom consumption has grown. You have not upgraded to some super alpha premium numero version of Zoom per se. You are still on that simple basic version. You constant, and your daily usage is not increasing crazily. It's stable. But from a revenue growth path, like where do you justify, how do you justify that revenue? And the way it is, there are so many equivalent supplements. If tomorrow Zoom increases the price by 50%, you will probably switch to Google Meet or something like that. So, which is why the premise is that consumption curve has flattened. When the interest rate goes up, the whole point of raising interest rate is to hit the consumption. If the consumption goes down, inflation goes down, which brings the equilibrium back. So now the root is, so people who are in the domains where the consumption is not hit, for example, health insurance. Health insurance did not go up crazy. India still has such low penetration of overall insurance coverage that you still have enough runway for the consumption to grow. Microcredit, you cannot say that you have a lot more runway to grow, and this is more beneficial for the society and everything from that perspective. And I'm talking about tier 1, tier 2, tier 3 consumption based credit. Trade credit is different, but consumption based credit does not have too much scale to grow from there. So that is where, so the verticals where you have opportunity, trade credit, FX, cross border, there is opportunity. India can manufacture a lot and to export. India can import a lot for machinery, for trade. You're making so many iPhones and so many phones you're exporting. So you have a whole supply chain behind it. There is merit to it. So those businesses are doing fine. But consumer, see, there is number of D2C accounts you can open. If 5% of Indians are paying tax, if less than 7 crore Indians are paying tax and 32 crores are having a demat account, that tells you that they have to now pay income tax. So if they're not paying income tax on that, because your farm income is tax free, your trading income is not tax free. So there is limited to how many demat accounts can you run profitably in
Yeah,
country.
yeah. Yeah, exactly. And obviously, there are different dynamics. Maybe they're not as active as we thought. Maybe somebody just opened an account, bought one share for the sake of buying it, and maybe perhaps never looked at it. So again, different dynamics also there on the demand thing and all. Yeah. But let me learn more from you on. The government has also changed a lot of norms. And obviously, on one side, government says that we are trying to make it seamless for the foreign investors to invest, but on the other side, there are a lot of hiccups. Are you seeing a lot of challenges for foreign investors now, specifically investing in India?
It's tricky because you see, you heard right when they just would send a notice out to the startup saying, ask your investors to provide the income tax return for last 3 years.
Right.
uh, and premises, see, there's a lot of focus on PAN card, which I understand from the Indian tax system. But
Oh,
imagine you are an Indian who moved to the US or moved to UK or Singapore, and you only want to invest in the startups. You don't have any Indian accounting. I can invest in the US startups,
yes.
or Indian can invest in the US startups without having a US social security number,
Oh,
right? But reverse doesn't work because
yeah.
now you need an Indian demat account. Indian demat account means you need a Indian PAN card, Indian Aadhaar, like so many different. I mean, you can get away with few of those requirements, but the premise is India is probably the only country which says you need a domestic dematerialized account for investing in startups.
Oh,
US, and which is the largest market if you see. If you want today to invest in US startup using an angel list or something like that, angel list, Republic, or anything, you could. You don't need to have a brokerage account in the US.
right,
You
right.
don't need a social security number in the US. From that, you don't need a tax ID per se for that.
Oh,
So if India wants to attract global investment,
oh,
transparency is one thing, but the premise is, and of course they look at it, okay, 95% investors are local.
oh,
It's fine. It
oh,
works for those 95 because they have everything. But for those who don't have it, then it
right.
becomes tricky because half of these things you cannot link to an overseas phone number.
Yes.
Even if you want to have a PAN card, you cannot link it to an overseas phone number. So then somebody who doesn't live, they need to get a phone number. And now the telecom bill says you must have a biometric. So then the person needs to travel to India to get a SIM card because the SIM card is biometric and your PAN card is linked to a SIM card. And then you need to pay every month to keep that SIM card active.
Okay. Yeah. So basically, it's going to be really tough for the NRIs who are, you know, setting up, who have settled abroad.
Forget NRIs. Imagine you're not even an Indian passport holder.
Yes, 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 yes.
You're not
Then,
even an Indian passport
yeah,
holder.
then you will not even get a PAN card and a mobile number here.
Because even let's
Yes,
assume you get a PAN card, you still need to open a demat account.
exactly, exactly.
So how complex it is for explaining to an American or a European or a Singaporean that
Right.
you need to open a brokerage account equivalent to invest in this one startup.
Uh, uh. But
So
any idea what roughly? I can see. I mean, this is really tricky, and we'll try to obtain more details on this. But any idea in terms of how much investments perhaps India will lose, or if that data you cannot average it right now. How much investments are the Indian investors who have settled abroad are making in Indian startups, which India can miss because of this tricky rules.
So I would say the easiest example is to look at this, right? All the YC companies.
Oh,
So all the YC companies or those who were incorporating overseas,
oh,
uh, because a lot of them are like they're saying they want to hold the Indian entity. Because if you want to do business in India, you want an Indian entity and stuff. So
great.
the premise is if you are working with overseas accelerator programs,
Oh,
whether it's Y Combinator or similar like that,
oh,
then either you are incorporating overseas. So either you are pushing your companies to incorporate overseas. But if you incorporate in India, then do you expect anybody going to a YC demo day to sign up for a demat account first?
great, great.
So, or other option is you pushing them to incorporate overseas. So the
Oh,
question would be, would you lose investment or would you lose companies before you lose the investments?
oh, true, true.
So that is a bigger risk. I expect that what happened in COVID, a lot of companies moved to Dubai or
Yes.
Singapore or Delaware for that matter, like a lot of
Oh,
these VC companies. So if you do not, so people, startups, fintech startups usually say, unless you need an RBI license, don't incorporate. So on one side, it's good for them to incorporate in India so that they can have a path to list and everything.
great,
But I would say the worst hit are the founders,
great,
not the investors. Because now founders have to make these choices. They have to make these tough choices. They
great.
can incorporate in India and be cut off from a YC demo day pool,
Oh,
or they can incorporate in US, but
great.
then flipping and everything becomes very painful, and the IP is overseas from that perspective. So I feel bad for the founders than the investor,
Great,
because the investors, if they want to, they will find a way,
great.
because the government will say, oh, what's the problem? You can always go through an AIF, you can go through this, you can go through this. Yes, it's more expensive. It's more painful. But so the way they look at it is this, right, Amol? Regulators or policymakers would look at the dollar value.
Oh,
They would not look at the number of investors, they will look at the dollar value.
great,
So they will say all institutional investors anyways come through that route.
great, great.
So if you're a VC, then you know that this is, and you have a staff to do it and you will do it. So the
Oh,
question is, they will say, okay, what percentage of the total capital for Indian startup ecosystem come from angels
oh,
and HNIs and who are non-India domiciled?
oh, oh,
So that honestly will come down to low single digit,
great.
because you're taking out PEs, you're taking out VCs, then you're taking out Indian domicile HNIs and angels.
Oh,
So then the pool left is HNIs and angels in terms of dollar percentage, not
oh,
number, dollar
oh,
percentage. That will not be massive.
oh.
Honestly, there's no way that's 25%. That's
Okay.
5% or lower, right? Because that's where it becomes less than 10%, I would say.
Oh,
Uh, so they're saying that's a much smaller problem.
absolutely. Ah, all good. Varun, let me switch last question specifically more on the future. Uh, how do you see now the future of fintech specifically for India? I mean, where do you see Indian fintechs going maybe next 2 to 3 years?
So I would say India FinTech, I'm quite bullish because
Oh,
of the large consumption story.
oh,
And it is probably it is the largest continuous FinTech market.
oh,
So if you see, you do not have 1.4 billion population as a market
yes.
anywhere else.
Oh,
You do not have that number of SMEs anywhere else as a market. So the fact that you have that big a market with one set of regulations,
oh,
we can always find areas of improvement in a regulation, that
Oh,
no regulation is ever perfect. But you have that big an opportunity. You have that big of a consumption story. And with the geopolitics, a decent amount of money will still flow to India.
oh, oh,
So from that perspective, the fact that the consumption story is there are not too many rivals if you're looking at a global capital allocator from that perspective to not allocate a decent percentage to India from that perspective.
oh,
I'm quite bullish from that perspective. Yes, of course, there could be few things which could be better to make life easy, to make it easier for the founders to do business. Uh, I believe at some point that would come up as a priority,
oh.
because if you are evaluating it from a number of people, yes, it's a problem. If you are evaluating it as percentage of dollars, it's a smaller problem. So that's probably someday it will happen. I mean, if I compare to 10 years ago how it was, it's much better today. So
Great.
hopefully it will be better from here.
Yeah, let's hope it will be better, and we'll stop here, Varun. Thanks for your time and sharing all these insights with us. I'm sure the unit viewers will enjoy the insights that you shared. Thank you so much for your time, Varun, and thank you so much for watching ETBS.